Hello and welcome to the Political Risk Podcast, where geopolitics and insurance markets meet. You're listening to a new special episode produced in association with Mosaic Insurance. Our theme is Financing Africa, banks, insurers, and the new geopolitics of capital. I'm your host, David Benyon. And to explore this subject, I'm joined by two expert guests. Katharine Villers is Vice President, Political Risk Underwriter and Head of Commercial Finance at Mosaic. And Nick James is Director of Structured Finance at ICBC Standard Bank. Sub-Saharan African sovereigns operate within a far more complex financing landscape than they did a few decades ago. After independence, many African countries lacked the domestic capital needed to finance their development and remained dependent on former colonial powers, international institutions, and state-backed lending. During the Cold War, finance became an explicit instrument of geopolitical influence, while the decades that followed brought a greater role for multilateral institutions and lending tied to economic and governance reforms. By the 2000s, the landscape had changed dramatically. African sovereigns were increasingly gaining access to international bond market commercial finance, while new actors like China, Gulf investors, as well as commodity traders and regional development banks emerged as important sources of capital. In this episode, we will examine how that financing system has evolved and where banks and political risk insurers fit within it today. Okay, right, I really enjoyed recording this conversation, so let's dive straight into it. Kat, Nick, welcome to the Political Risk Podcast.
Great to be here.
Thank you for having us.
Before we get into the modern market, could you briefly, I'll start with Kat and then Nick as well, just set the scene for how financing of Sub-Saharan African sovereigns has evolved from that whole decolonisation, Cold War era, through into the millennium as they gained access to commercial finance?
So if we go back to the 1950s and 60s, so that's when many countries across Sub-Saharan Africa were gaining independence. So they had political sovereignty, but they didn't often have the domestic capital they needed to finance their development. So they had to rely quite heavily still on external financing, and much of that still came from their former colonial powers. So even though direct sort of political rule had ended, those financial relationships meant geopolitical influence continued through economic ties. And then during the Cold War, finance became an even more explicit geopolitical tool. So the US and the Soviet Union were competing for influence across Africa, using aid and infrastructure investment and sort of state-backed lending as ways of strengthening political relationships and expanding their influence. And then after the Cold War, that dynamic changed again quite a bit. So there was less direct geopolitical competition. And then also because of the African debt crisis in the 1980s, institutions like the World Bank and the IMF became much more prominent, and financing became linked with sort of strict conditions around economic liberalizations and in many cases democratic reforms. So I guess the focus shifted away from asking which side are you on to sort of what policies are you willing to implement. But even then, that's all reflected the sort of priorities of a Western-led international financial system.
That's all that kind of unipolar moment.
Yeah, exactly. And then in the 2000s, that's sort of when global financial markets became more integrated, and many African sovereigns were able to access the international bond market for the first time. So governments could raise capital directly from private investors rather than just relying on bilateral loans or the World Bank or the IMF.
I think I became aware of the market strength in supporting African exposure around about 2011 when I moved into a bank that was looking to be more active in its credit portfolio management, looking to shift some of its larger exposures to allow it to do a little bit more business with its clients. The bank that I was with at the time were at the stage where the CDS had proved not quite as effective as we'd all hoped in hedging credit risk. And the insurance market was there for us. At the bank I was with at the time, the need was more for large-scale, highly rated exposures that they were safe, but they got very, very big. And we're surprised to find out that these were harder to hedge in the insurance market than the likes of Africa and Central Asia. So I think at that time, it was when I, with the team I was with at the time, started to tap into that expertise, and it did allow us to do a lot more business in Africa and across Central Asia.
Well, I suppose we're in a whole new era now. And how are some of the new sources of capital? I mean, there are still some geopolitical actors involved. We are in a competitive atmosphere in Sub-Saharan Africa. So you got the banks, you've got commodity traders, you also got, as I suggested, those government-backed investment projects as well, and the regional development banks that you mentioned. How have all of those actors changed the financing options available to African governments?
It's definitely a lot more complex now than it's sort of ever been. The positive, obviously, is that all those countries now have way more opportunities to access finance. But because of the issue of geopolitics and managing that, maybe it could be said it's a bit more complex now than just managing maybe just the US versus USSR dynamic. Because you've got like multilaterals who will be concerned, with fiscal discipline and good governance. And then you've got commercial creditors like banks, and they are going to prioritize return, and they're focused on sort of sovereign creditworthiness. And then you've got commodity-backed financing as well, and that's going to be about long-term resource commitments, and traders there are going to be worried about fluctuating commodity prices. So that means that governments end up having to think of multiple things at the same time. So they're going to be worried about bond yields and credit ratings and commodity markets and investor sentiment, rather than just thinking about which lender it can get financing from. Something that we're seeing in the insurance market is that financing relationships aren't the only thing that's changing. So we're seeing it a bit in currencies too, and I'm sure obviously the banks are as well. So the dollar is still the sort of dominant global reserve currency and trading currency, but we're seeing sort of more currency fragmentation. So we're seeing the Chinese renminbi is playing a much bigger role in international trade. And for an insurance perspective, we're seeing so many more requests to cover transactions denominated in that currency, particularly in those countries where sort of China's a major source of financing. And I think that's just going to be a trend that we're only going to see like more and more of, because emerging markets are going to want to diversify their exposure and reduce their reliance on the dollar. So we've left that era of broad global integration and now more focused on geopolitical alliances. And it's just not just who can provide the financing, but navigating that geopolitical landscape. And I think African governments are probably becoming more skilled at that and using that competition to advance their own development goals.
A couple of the areas that mentioned there, commodities, yes, we have volatility, sovereigns, we've always got need for sovereign financing. And the points that Kat made there, that there's volatility, we've got currency, we've got commodities volatility, we've got geopolitical risks. We've got a scenario where rates are probably going to be higher for longer in the US. It's not the kind of environment where you'd expect to see an increase in risk appetite from banks. It's probably going to be tighter. If anything, along with the tighter capital management that we're required to carry out right now, it's not the kind of environment where risk, you're just going to say, okay, well, we're happy for you to take more risk. So that kind of need is going to continue and be stronger. I certainly think the need for renminbi, I would agree with that, particularly talking about a lot of African sovereigns. You'll find certain countries, if they're an oil exporter, I'm thinking of one oil exporter at the moment that exports 70 to 80% of its oil to China, and it's being paid in renminbi, of course. At the same time, is using that oil revenue to improve infrastructure domestically. So it's building schools, it's building roads and railways and airports and water facilities, as you'd expect. And a lot of those are being built by Chinese construction companies. So the need there is to raise renminbi to pay for those products. And the source of repayment is also in renminbi from selling oil to China. So that need is getting stronger and stronger. I think the only difficulty that we're having at the moment is that the renminbi is not a settlement currency on Lloyd's or in the market. So you do have a currency mismatch. You have to buy your insurance in dollars. It's a very stable currency. It's well managed. But it does leave that mismatch on the balance sheet that risk is not going to ignore and management is not going to ignore. So it's early days for that product, I think. But over time, as it grows, I think that mismatch is something that we'll have to address.
So let's just, before we go any further, Nick and then Kat, explain your own roles and where you and your organisation fit within the whole ecosystem.
I look after the credit insurance, the non-payment insurance for the bank. And I sit in a unit called structured financing that looks after the loans, most of the loans for the bank. There are separate units that manage repos, for example, and swaps, kind of derivative transactions where they're used for financing, which can be equivalent to a loan. They just use different documentation. And also on the commodities side, we'll have loans to our commodities clients or some good old-fashioned stuff where somebody's delivering some metal or digging it out of the ground and delivering it, or delivering oil, but it could be in a difficult jurisdiction, for example. So we'll go and insure some of that risk with the insurance market. So what we'll find is that there are various relationship managers around the bank. They want to get all sorts of business out of their clients. One of the best ways to do it is to lend them some money, finance them. That pleases the client. So that loan, that seals a relationship. That's your band of gold. So what the relationship manager will find is maybe the client will say, we want 100 million or 200 million. And then that relationship manager will go across to credit that sanctions the use of credit. And they'll say, no, you can only do 30. So what do you do with the other 70? If you turn up to the client and say, well, we've got 30 million and we're good for it, they'll probably say, well, thanks very much, but no thanks, we'll go elsewhere to someone who does the whole size. So that's when the RM will come to me and say, do you think this is something you can insure? Relationship manager. Then I will go off to the broker. I will then talk to the likes of CAT to see if there will be capacity for that. And we'll maybe put an indicative syndicate together of a group of insurers that will say, okay, in total, we'll do the 70 million and the pricing works. So that'll form part of our credit write-up. We'll say, okay, we want to do 100, 30 million will be our own risk, clean, and we have this other 70 million of insurance from the market, and we'll take that off to credit committee. And if credit committee approves that, then we will go ahead and lend the money to the client, sign the facility agreement, and at the same time sign a policy with the market.
I'm an underwriter on the political risk team at Mosaic. Essentially, our job is to help our clients do business in emerging markets by ensuring the political and credit risk that they come up against. And I'm responsible for the commercial finance side of the account. So I work with banks, so with Nick and sort of other financial institutions when they're trying to finance projects and investments around the world. And then I guess within that, my main focus is probably on the risk that the borrower doesn't repay a loan. So essentially, we're sort of covering debt. And I think, as Nick said, as the sort of commercial banks ended up becoming more active lenders in the region, and they sort of ended up having more sovereign and political risk sitting on their balance sheets, they sort of came to us because we can help them manage that exposure so they don't have to tie up lots of capital against country risk.
As capital say, there's a danger that the borrower doesn't pay you back, or the person who's taking delivery of some oil or metal doesn't pay you back. So it's important to understand that risk. So you start first off with a term sheet. We'll give you this much money for this purpose, and we expect you to pay it back on this date. So then you have your cash flows. And it's those payments, those principal payments, usually, we often don't hedge or insure interest because it makes it more expensive. It's the principal that we want back and qualifies us for capital relief. So credit write-up. We're normally talking about loans to established clients. So we've got quite a lot of information, but there needs to be a credit write-up for the committee for the current transaction. Everything needs to be updated, all the financials, which is to make sure the directors of the company, their backgrounds, for example, are all up to date. And
but these can be government entities, right?
Government entities. So in that case, we'll have some of our sovereign analysts write up the political background, how the currency is doing, how the debt markets are doing, are their interest rates going up or down, and why?
They're excellent write-ups.
Oh, thank you very much. And you want to know about the characters in the government and the relevant Ministry of Finance. We do tend to push towards central banks where we can, because we've looked endlessly through the history of central banks, and you can't find many examples of a central bank actually defaulting. They tend to just make money to pay back. And we were looking through, as obviously there was Russia in the 90s. And before that, Cuba, was it actually a default, or did the building just burn down? And so that's a questionable one. And looking through the previous one we found was the Bank of Austria, which defaulted during the Napoleonic Wars. So it's quite rare, these events. So we tend to look for central banks where we can, or the Ministry of Finance. So all of this will be put into the credit write-up, which is about 30 pages long. And that goes to credit committee once the front office has put a comment, legal has written their comment on the documentation. Is it tight? And credit also, the credit sanctioning officers, they'll do a write-up as well and make a recommendation at the end. So that has to go to the senior committee to be approved or not. And this is what we understand is what the insurers are interested in. That often we hear from, could be corrected in a second, we can't guess when they're choice, but the point is that it's more important to understand who you're insuring than what you're insuring is a mantra we often hear from underwriters. So we want to share that process with the underwriters to show we've been through a thorough process. And the easiest way to do is show the document that we've used to approve that risk, and hope then the underwriters will then be prepared to make a bet on us.
It's still so relationship driven, isn't it, within the market, that we rely on those relationships and that information that you give us in order to make an assessment of the risk.
Yeah. So at the same time, we'll be taking that to our credit committee to approve the relevant loan or repo or swap or whatever it is. And we'll be working on the policy wording. So the policy will then point to that specific exposure, that specific loan that we're making to the sovereign or to the company. In our case, ICBC Standard, that's mainly emerging market sovereigns, is we do more of that than anything else. That's why there's such a good marriage with the insurance market. And so the cash flows will be identified under that particular loan, that particular exposure. And that's going to be listed up in the policy. In the policy, we'll name that particular facility and we'll say principal payments due to us, ICBC Standard, the bank, the insured in this case, is what we're insuring. And we'll always keep a bit of risk back to ourselves because, of course, the insurance market wants to know that the risks are aligned. The fortunes are aligned as well. If it goes well, we'll both make money. If it goes badly, we'll both lose money. So we're not just dumping all of our risk onto the market. So then it's really a matter of just signing the policy with the underwriter and then keeping them informed. If there is some kind of waiver under the policy, for example, we'll get in touch with the underwriters first to say, this is coming, do you agree with it? And of course, if we think that there's a whiff of a loss, then we'll get that to the underwriters quite quickly as well so they can prepare themselves as well. But thankfully, it doesn't happen that often.
Well, Kat, so from your side, what types of risks are you willing to take onto your balance sheet? And conversely, what are the accumulations and risks that you're keen to avoid?
I guess just, again, like Nick, like looking at it from when we start seeing a risk all the way through. So I guess when we get a risk through from the broker, we start by assessing the underlying obligor. So that's the counterparty in the transaction. And we're sort of interested in the structure of the deal, I guess the macroeconomic environment of the country. And so I guess the broader sort of political and economic outlook. And then often sort of some of the transactions we're seeing, they can be like 7, 10, or even like out to 15 years. So we're trying to make sure that we're not looking just at the current probability of default, but we're also thinking about future political and economic factors that might influence the deal over the life of the transaction.
And you'd hope that's in the credit write-up as well.
Exactly.
Yeah.
I'm sure it would be. And then you were saying about accumulation of risk. So obviously we assess each risk individually, but we've also got to manage our portfolio as a whole. And we've got to understand where we end up having sort of concentration of risks. So I guess where like multiple transactions could be affected by one underlying event. The most obvious there is a sovereign crisis or a default or some sort of like major commodity shock. So the whole time we're actively managing our exposure by country, by obligor, by sector. And then we also try and stress test against like different scenarios. So we were doing that in the high oil price environment that we saw in 2-3 months after the start of the Iran war. So a lot of what we do is kind of trying to think about what might go wrong. And that's where geopolitics is still so important because obviously in the countries that we're doing business in, we have to think about potential political instability or a change in government or just a general change in the broader global environment. And that's all going to affect how we assess the risk.
That word concentration comes back again and again, doesn't it? It's really quite important. It's important for the insurers as well because there are certain risks that we would bring. You say, no, we're full up on capacity with that already, obviously. But on the bank side, it's important. It's why we're going to the market in the first place. From the front office point of view, the relationship manager that's talking to his or her client wants to do as much as possible as well. So it would be unusual for someone, maybe somebody would be really, really responsible in the front office and say, actually, I've got a bit too much to ABC Corporation or too much to Narnia at the moment. Perhaps I should rein myself in, but relationship managers are not really there to rein themselves in. That's what you've got management and risk units for, to say, hold on there, cowboy, we've got too much there. So we're not really responsible for the concentration in the front office. It's really that's given to us. That's already provided for us under the bank's risk network. So a lot of it is reacting to that. And when you hit a brick wall, when you go to credit, that's when you need to go crying to the insurance market for help. And the overall result of that
So you're told when the bucket's looking nearly full.
Yes. So that's right at the beginning of the process, that concentration, how much is appropriate, whether, what the risk looks like now, what do we think the risk looks like over the life of that 5, 7, 15-year term that the Cat was talking about there. So all that comes into that calculation.
Yeah, and like insurance is so important because the risk sharing is so important and that we help you guys lend more and for longer tenors potentially and then ultimately get those projects financed and done.
A little bit more added scale, it means you can engage with more clients, more counterparties and have those relationships.
Absolutely. If you want the ancillary business, you've got to use more of your own balance sheet. And there's a limit, no matter who it is. Even if it's Nestle or Toyota or something, there's a point where you stop. And of course, with emerging markets, you have to stop taking clean risk a lot earlier. Otherwise, of course, the shareholders and the regulators would rightly be asking what's going on.
I wanted to ask you about some of the multilaterals and the development finance institutions. How does their involvement affect the way that banks and insurers look at these deals? And are there some of those multilaterals that you particularly want to highlight as being particularly active?
Yes, I'm sure they won't mind my mentioning them by name, but ATD, the African entity, they've been very supportive of us over the years, and also ICIC, which is part of the Islamic Development Bank. So two areas that they've been very, very helpful to us is ATD, obviously Africa. It's owned by 20-odd African countries. And ICIC, there's plenty of the Islamic Development Bank, but there's a lot of Saudi support in that as well. So that's got a reputation for being solid and safe. But where they help us is there are certain transactions in certain jurisdictions where we don't have boots on the ground, for example. So if something does go wrong, then it's more difficult for us to fly someone down from London and go out looking for recoveries.
So it's really not just a question of balance sheets. It's the fact they have those relationships and those resources.
It is, yeah. Because they're preferred creditors. ATD case, that's actually by law. And ICIC's case, it's de facto. They've got the relationship.
So they also get preferential regulatory treatment as well.
Exactly.
Yeah, okay,
so
right.
The regulatory treatment for these two, there's not really that much of an advantage in terms of capital relief. But in terms of the way the bank would look at them as a credit, it's very different. Because if we're lending money in their member country and something does go wrong and the insurance has to pay out, then that particular entity will have preferential treatment when it goes into its member country and asks for preferential treatment in its recoveries.
So are they your partners as well as your competitors?
We look at them as partners. They're nice enough to treat us as clients, and that's very nice. But I think the reason is that we can get more done with them is because they're laying off risk with the likes of CAT.
They're reinsuring it to us.
Right.
Some transactions we may see the reinsurers as Lloyd's entities, companies markets like non-Lloyd's insurance companies from Lime Street and Fenchurch Street, but also the usual Swiss Re and Hanover Re and Munich Re's and the big reinsurance companies of this world. And the way I understand is, which is actually, it could have been a question for CAT, but why we get to do so much more business with them is because the insurers are happy to stand by them and reinsure them, because the recovery and assumptions can be so much higher. Because the development finance institution better go into that country, say, member country, we've just lost money, you need to pay us out within a 360-day period or whatever they're doing. So
I think the thing for us is that if there is a sovereign crisis, we would expect those deals with the multilaterals, those payments to still keep going for as long as they can. And then if there is a restructuring, we would expect that financing to also be excluded from the restructuring and almost make a full recovery on it eventually.
It makes a lot of sense where sometimes you can take a transaction to the insurance market in a quite a difficult jurisdiction, and the underwriters will be quite honest and say, we can't insure you directly, you, the bank, directly. But if you get a DFI involved, we're prepared to stand behind the DFI so we can get more difficult transactions complete that way.
Let's round off with an outlook question, a forward-looking question. So very broadly, how you see geopolitics and economic forces in Sub-Saharan Africa shaping the next phase of sovereign and infrastructure finance. What does that mean for the relationship between banks and insurers?
I would say following on more from what we were just talking about, because there's such a significant sort of infrastructure financing gap in Africa, I think that's where the role of the private insurance market is going to become more important. Because what we're going to see more of is the insurance market acting not just as a provider of risk transfer, but also as a catalyst for private capital. Because we know that obviously the banks can't meet Africa's financing needs alone, and neither can sort of the multilateral development banks. So insurance has got a role to play in helping find sort of innovative financing structures that get institutional and private capital involved together with banks, DFIs, multilateral development banks. And then that's going to make it possible to finance these like much larger and complex projects, sort of what Nick was talking about earlier. And then in terms of like the role, I guess, of the private insurance market and with the banks, I think that's also going to become more important. I think we saw with the restructurings in Ghana and Zambia, it's taken so long to get completed. And that's because there's now so many more creditor groups involved than there ever used to be. And that means that negotiations are taking so long. So that's why our role, I guess, is quite important for you guys now, is because if there's a covered default, we'll pay the claim and that frees up capital for you. And then you can continue lending and supporting sort of new transactions rather than sort of waiting years for that restructuring to run its course.
I think I'd be looking at growth for this side of business. Looking back, it should be obvious, but I've never been this busy or seen a bank this busy. So many bigger transactions coming through. I suppose having done this for 15 years in London, and also specialising on this side of the business for my last 5 years in Tokyo before that, GDP has been growing, economies are bigger, stock markets are higher, commodity prices are higher. It should be kind of obvious that at some point we were going to get busier. There were going to be more transactions and they were going to be bigger. And in that now, I think the lessons of the financial crisis haven't been forgotten. I think we know that there's all sorts of the risks that we talked about earlier, and not just going to come from within Africa. You've got these benchmarks of risk like the S&P, like who's in the White House, what's happening in European governments, but what are the dictators of the world doing? So I don't think the risk appetite at banks, particularly when you've got the regulators watching us so closely still, I don't think the risk appetite is going to be able to keep up with the volume of business that we're going to see going forward. So from time to time, we're going to see a bear market. We're going to see 20, 30% down in global stock indices, and we'll sit on our hands for 6 months or maybe even a year at some point. But over time, I can only see the size of transaction, number of transactions getting bigger and bigger, and our needs to cover that risk as credit capacity of banks doesn't keep up with that. They need to partner with the private market and with the development finance institutions more and more. Over the years, I say I've been surprised over the last 2 or 3 years. Should have been obvious, but sitting there thinking, where did all this come from? And I think, 5, 10 years' time, it's going to be even bigger.
And that concludes this special episode of the Political Risk Podcast with Mosaic. I'd like to thank my 2 expert guests for a fascinating discussion, Katharine Villers from Mosaic and Nick James of ICBC Standard Bank. Until next time, thank you for listening and please tune in again. I've been your host, David Benyon. Production was by Peter McGill and Lawrence Durkin made the music.